All right. Good morning, everyone. Good afternoon, good evening. Today we are going to be discussing about the second class for Volume 1. I put the title. Volume 1. Put the title. There it is. The class 2. It's always in the way. Yeah, it's fine. So we're going to be talking about the algorithmic price delivery that the market has and uses every single day to deliver price efficiently, right? Towards the targets. As you already know where the market is finding efficiency, and you already know what the market is targeting every single day. Not because buyers or sellers, but because there's going to be liquidity there. And the market doesn't need to know you have liquidity there, it just knows where everyone will post their liquidity. And it's going to go there. It's just the nature of price, timing price. Beautiful, beautiful. But let's talk about the 4 stages of the market that the market uses in order to deliver price efficiently. So first we have consolidation, and this is the most important stage of the 4 because this is the origin of everything else. Everything will start from the consolidation, okay? Then we have expansion. Finally, we will have retracement. No, finally. But then we will have retracement and have a little something in your mouth. There it is. And now finally you have reversal. Is like that. So normally, the way that I would expect the market to deliver every single day is going to be in the following pattern. I don't know why I cannot put Friday in the middle without this looking without making this look crooked. Is it crooked? I don't know why I feel like this crooked. It's so annoying. This is the middle. Yeah, so probably this was crooked. There, is that better? And then this. Because if I don't fix this, it's gonna be bothering me the whole class. That's reason. Okay, at least this validation. Okay, I think that's better, right? There it is. Good. I'm sorry, but I cannot prevent myself from paying attention to these little details with my eye. Just like it's gonna bother me, like that little thing in your eye. You have like an eyebrow in your eye, not like an eyebrow, but an eyelash in your eye, and you're gonna be blinking too much the whole day. Or when you have like a little piece of meat between your teeth, and you're gonna find yourself looking for that piece of meat with your tongue. So this is the way in which I expect the market to deliver every single day. Okay, now I think I messed it up. Okay, there. Okay, consolidation is the beginning of everything else. Okay, consolidation will start the move, and after consolidation, I would expect the market to deliver to an expansion. So after consolidation, I would like to see an expansion. This is normal and algorithmic. Sometimes you will see that expansion leads back to a consolidation. When you see this is not often happen from the expansion to a consolidation, but it can happen. This is why I put it like this arrow, like that. But what will happen normally is consolidation to an expansion and expansion to retracement. This is normal and expected. After retracement, I expect to see another expansion. Here. Good. Now, what I don't want to see and I don't expect to see is from retracement to reversal. Now, this is the part that I take a little bit long to make it look good. This is good. Give me 1 second. Here. So from the high. Yeah, this is fine. Now from here to here. Oh, there it is. So from this to this. Okay, so from this to have to be closer. Yeah, okay. I'm using that as a measurement tool. Imagine, bro. Okay, expansion to retracement. I'm sorry, retracement to reversal. This is not what I expect to see. No bueno. And if you ever see a retracement to reversal, then that wasn't a retracement. That was a different thing that you're going to learn in the last class of this volume. So don't worry. The other thing I don't expect to see is consolidation to reversal. And again, if you see consolidation to reversal, then it's because that was a different thing that wasn't a consolidation. It was going to be another thing that you're going to learn in this volume as well. What you can see also is a reversal after an expansion and an expansion after a reversal. This is normal. So please take a screenshot of this and let me know when you're done. Right? So let's talk about the consolidation model. The consolidation. And this is the first model that you're going to receive. So the consolidation is going to be the origin of a price run. I'll make this one a little bit bigger. This one can be a little bit smaller. Ideally there. Okay. And what it's going to be useful for is because it serves to engineer liquidity on both sides of the marketplace. It shows when the next stage of algorithmic price delivery, which is, as you know, expansion, is near. So what do we want to be paying attention to? We pay attention to the high of the range, the low of the range, and equilibrium, or 50% of the consolidation range. So let me make this one pretty for the eye, because what is pretty for the eye is easily digested. So if I want to capture your attention and I want your brain to remember this, it has to look good and symmetrical. Color coded as well. Everything has a reason. Nothing is random. Although I love to use that word because it's really fun. Okay, good. So let's say you have found a swing high in your hourly time frame or 50 minutes time frame. And you can identify the consolidation because you see the market being compressed and trapped, sort of saying, inside of this specific range. So the market is going to be showing you that it is not being allowed to move outside of this little box. Going to be compressed here for a long period of time, and suddenly it's going to be ready. Okay, so let me put it like that. But once you understand and once you can identify correctly the expansion, or I'm sorry, the consolidation, you will know that the market is doing this for a reason. And what it's doing is to bring willing participants into the marketplace with their opinions. So here you're going to see banks, funds, institutions, speculators, retail traders, etc. And they're going to have an opinion. They're going to believe that the market is either going to go higher or lower, right? So those of which believe that the market is going to go lower, they're going to be selling this. And they're going to put their buy stops where? Above this range, right? Because they think that this high of the range is going to be their resistance. Good. So they're going to believe that this is going to be their resistance. They want to be selling this. They want to put their buy stops above this high, and this is creating buy side liquidity above the market. On the contrary, you're going to have also willing buyers who are thinking the opposite. They want to believe that this is support. They want to be buying, and putting their sell stops below the marketplace. This is creating sell side liquidity. Good. So now the thing is that they can also put their buy stop here to enter on a breakout higher, because retail traders usually have breakout strategies, and also sell stop below here. So the market, when it breaks this quote unquote support level, gonna keep the leverage lower. So I'm very clear here. Not that I am trying to show you this is the way, because this is not what we teach here. This is not what I expect you to do. Okay, this is not what I'm trying to teach, but this is the way they understand it. Okay, and we have to know how they see the market, because we are going to be taking advantage of that. Good. So you want to be now paying attention to the high of the range, which is going to be defined by the bodies of the candles, not the wicks. Okay. Why just the bodies? Because in the bodies of the candles is where the bulk of the volume is. So now I'm paying attention to the low, and this is going to be found the same way. Nice. Once you have your high of the range and the low of the range, you want to pay attention now to your equilibrium, right? Which want to be, oh, I made a mistake here, nobody told me. So you want to be paying attention to your equilibrium, which is going to be the 50% of the consolidation range. This is going to be very, very, very important. For what reason? Because what you're going to see here is that you're going to see a recurring phenomenon that will sometimes, most of the times, you're going to see that the market. So first of all, I am not looking for this, okay? Just in case. I am not going to teach you what you have seen in the social media environment, which is one box here, the other box down here, because I get this question a lot. Another one like this, like that, okay? And they have like something here, here, and then here. So this is not what I want to be teaching you. In this consolidation model is not that, okay? This is another thing. And that pattern is just the way they explain it is flawed. Anyways, I do believe Power 3. I have a class for that, but I have the properly class for that, but not that. And this is not where you will know what you are going to be looking here for. So I won't tell you that I want to see one side rated and then deliver towards the other one. No. What you want to see here is that the market is going to have some intra-range rate on liquidity, or sweep liquidity more specifically, because there's a difference between a range and a rate and a sweep. You're going to have some sort of intra-range sweep of liquidity, and you're going to have the low of the consolidation range bouncing or acting as quote-unquote support, which is going to be a rejection block right here from the body of the candle. This is going to make the market to inverse the 50%, and this is where you act. So you can enter, of course, down here. Once you know what you're doing, target all the way towards the target, and the stops will be very, very small. But what I want you to pay attention to first is going to be how the market reacts off of the low end of this consolidation model. If it inverses the 50% and you're going to notice that the market makers, oh yes, I like to call them men in black, are going to give you a hint in the form of a p-value, which is going to be an order block or fair value left, at or around the 50% or equilibrium of the consolidation range. Okay, so here around this 50%, you're going to be looking for a bullish order block, and you have the order block. You have the PDRS video for free in the VIP content, volume 1. I have put a free video for all of you that have paid for the mentorship to watch it. Okay, that is additional. That didn't come with the package. where because of many requests that I had on Peter is this and Peter is that, I created it. So now you don't have an excuse. Now you know everything in terms of that for you to receive this class. Guess you're gonna have a bullish order block around here and or a bullish value gap around the 50%. So once you have reached this level, the market can deliver towards the buy side in two ways. Okay, it's either gonna break the high, leave a gap here, and then deliver towards the buy side. And this gap right here, the first gap that the market leaves, can be an eye effect, okay? After breaking out from the consolidation model. What's an eye effect? An eye effect means institutional order flow entry drill. This is practically a partial entry into a bullish fair value gap or into any fair value gap. So when the market leaves like this, it's gonna come here. As long as it doesn't reach the consequent encroachment or the 50% of the bullish fair value gap, that's considered an IFL. And that's exactly what you want to see when you're bullish. You don't want to therefore enter on the 50% because you can run the risk of not being in the trade. The best longs are going to take place in the upper portion of the bullish fair value gap. Same thing for the shorts, right? In the lower portion of the bearish fair value gap. So you want to be entering here. Because sometimes the market comes here, but if you're just requesting that every single time, you're going to miss some wonderful, wonderful trades. Anyways, sometimes the market is not going to even come back to this gap. It is not going to touch it. And when that happens, this is going to be called a bag. And the bag is essentially a breakaway gap. So I have YouTube videos that I am trading this, and I literally tell you that this is going to be a breakaway gap. Okay, so I mark it before it happens, because normally you're going to have breakaway gaps forming after leaving a consolidation like this. Now, the other way that you can see the market delivering towards this buy side is from this same place. You could see the market breaking the high, closing very near from the high of the range, HR, and it's going to use this upper portion as quote-unquote support, and that's going to make you see higher prices. Low and steady, but it will deliver. Okay. So please take a screenshot of this and let me know when you're done. All right, good. So let me show you something now. Let me see how can I do this. Okay. So I'm gonna show you this trade that I took right here. So this trade was me looking for a loan, and the first thing I did was recognize and identify correctly the high of the consolidation range. How do I know? Because look at the bodies are stopping right here. So the bodies are telling me right away where the high of the range is. Okay, so you can see how they are not allowed to leave this level. So they're stopping right there. So this is the high end confirmed, and then the low end is going to be the lowest body. Later, the market is showing me the same idea and is respecting this low with the bodies. Hours later, okay? So my low end of the consolidation model has been tested and confirmed. What do you have inside of this little range? You have this swing low that the market has taken. So what is this? A sweep on liquidity. Sweep, sell side swept right here. Look at the behavior in the low end of the consolidation range. The market goes there. What does it do? Tries to go higher one more time and then starts delivering higher. So what was the next step? From the low of the consolidation range, low of the range, the market inverses the 50% with this candlestick right here. The market is not just doing that, but is also inversing this CV, which is this bearish fair value gap that helped us to go higher. Bearish value gap that helped us to go lower, and then it got inversed. So now because it is inversed, its nature is going to change, and now it's going to help us to go higher, right? Just like a BC. But its first nature was a CV. So this is why we call it inversion value gap, because its nature has been inversed. And or in a terminology more simpler, everyone will understand, this was resistance, now close above it, support, right? This is the real support and resistance, folks. So now that the market has inversed that, you have this down close candle before the up move that can be used as your bullish order block. You also have these down close candles before this up move. This can also be used as your bullish order block. And where is this resting at? Yes, exactly the 50% of the consolidation model, which is this red line. And this is also a gap around that 50%. So the best entry would have been here, right? I was bearish at this time, I did not enter here, but I am not entering late because I am still inside of this consolidation range. So as you can see, the market, so this is still on time. And what you can see is this is the first or the second way the market can deliver. It's the second one, right? Because we're closing near the high of the range and is using it as support. Look at this. The same way we behave around the fair value gap, only the wicks are going through. Once you close above it, only the wicks are going through, but the bodies are staying outside of it. Algorithmic signature that we are still we are indeed going to keep pushing higher. So then what do you see? You have the market closing over the high and the same signature. Just the wicks are going through, the bodies are staying above it. So I am entering long before that. My stop loss is at the 600s. My entry is at the 611.75 for, let's say, let's run it up to 1200 stop loss. And the first target is above previously high at 742, so I exit at 744. So from 600 to 700, let's say it's above 100 candles. The first partial. The next one is taken above this target, the blue line. It was a swing buy side liquidity that I found on the 1 hour time frame. Buy side liquidity. So 788, I knew that it could go higher, 820, so I'm exiting at 824, so around this, for a total of above 200 candles. I'm not gonna be specific here. I want you to pay attention to the idea, not the handles. This will be a total of above 300 handles by the consolidation model, risking 12. So what is the takeaway here? When you're in the consolidation, the ranges are gonna be very, very small, right? Very, very compressed. So you can enter with the same amount of risk that you will normally take before the large movement, before what? The expansion. Remember the bullet points. So now the only worry is to just move your stop loss to break even and take partials, and that's it. You're done. And then look at the market, just start chopping, right? So this is one of the things that the consolidation model will bring you. Okay, let me close this. Let me show you something else. This is also another model for that. Whenever you have swing high, layer like this is high probability target. And what has the market done? Pushed higher, and this is a way in which you see expansion consolidation, right? This is one of those little times in which it's low probability, but it will still happen sometimes. So what do you see here? You see that the market is being compressed from this high to this low, back and forth for a long period of time, chop, and we don't worry. No, don't worry, mama, don't you worry, no. I'm gonna take you from the first to the 20th floor. What do you have here? This swing low is rated. Do we touch the low end? Do we inverse the 50? No yet. Now you have not the swing low, is swept. We touch the low end of the consolidation range, which is with the bodies. Low end rejected. We leave a BC, so you can either enter here or wait for more information. Then we inverse the 50%. And what do you have here? Group of down close candles. This, before this up move. Okay, so this makes this a bullish order to the right, and it touches it to the tick, and higher prices. Which delivery is this? The first or the second? The second. Why? Because it's closing above the high by a tick, and then it's using the high end as support, right? High end is used as support. You can see more examples of this given to you in the Indian Music channel, which is a public channel. Okay, that is a free channel. And I'm gonna put a poll to see if you guys want to see that channel stay free or to become private. Anyways, let's look at other examples. I have plenty, Mr. Plenty. Now you have other example here in which we are consolidating inside of this little range. You have the high of the consolidation range, the low of the consolidation range. The market is leaving you a swing low, tries to go higher, fails to take the highs, all the way back down to the swing lows. It takes the sell side, touches the low end of the consolidation, which as I told you is going to be a rejection block. Last chance to start pulling higher. Touches it, touches it, touches it. Now it starts pulling higher. Inverses the 50%, and around here you have a bullish order block. So I am using the high, the low, the 50%, but the opening price also. So if you pay attention to this group of down close candles before this up move, this is also a bullish order block from this high to this low. So I'm paying attention to this one as well. So you have a strong likelihood of here that the market will use as a support to start delivering higher prices. Now here I want to show you something. So the market is using this, delivering higher, and this CV right here is being inversed, just like the first example. So once the market respects the bullish order block, that is around 50%, this rally gap is also around 50%, and because we close above it, you can use it as an inversion. The market closes above it, comes all the way back down here, and starts displacing higher prices. What does this leave you? A bullish order block again. Why? Because this is a single down close candle, or it can be a group as well, but in this case, it's only one. The down close candle before the up move. So the market uses that as support, gives you a bullish rally gap also, and then continuation. In which delivery is this one going towards the target? Is in the first or the second? The first. Why? Because it's breaking the high with a gap, and it's not even touching it, just touches by a tick, so this is a nine of it. Okay, so this high is not being visited because we have displaced higher. So we have left a gap. Market uses this gap and starts delivering strongly towards the buy side. See that? Okay. And if you would like to see more examples about this, I invite you to go to the Inner Musings channel because I have a lot of examples there, but let's just finish with this one, okay? So you have the same idea than the other example, the one before the last. The market is consolidating here in this range. You take out this sell side. Sometimes, as I told you, not always want to have an intra-range sweep, but I am always paying attention to the low end. Touches the low, inverses the 50%, and you also have this group of down close candles, the order block. I missed grab it. It's not this one, it's the one up here. But I am signaling this one because it is in concert with the 50% of the consolidation, okay? That's why. Closes above the 50%. Now you have the group of down close candles, uses the 50%, and this bullish order block right here, this opening price, then to the right, market taps into it, and delivers higher. In this case, the market was so choppy that this place is higher, and it comes back later because it doesn't tap into this survival gap into the high end, and it uses this as support once, twice, three times, and then it delivers towards the buy side. It takes its time, as I told you, sometimes when it uses the high end as support, but it ends up delivering, right? Which is what we want to see. So you're not going to be afraid of, oh, should I get out? Should I hold? What should I do? Because you know the model. You know that the model has to deliver. You just want to wait there patiently and look at it take profit. Or stop loss, right? Who knows? And then you're going to journal that, and that's going to help you to become a better trader. And that is essentially going to be the class for today. The homework for you is going to be finding this consolidation model in hindsight, marking it like this. You're going to find it. You're going to look for this on the 5-minute or 1-minute time frame, whatever time frame you like the most, between 5 to 1 minute. It can be 3 minutes, it can be 2 minutes, I don't care. But you want to pay attention to the consolidation model in that time frame, because in that time frame you're going to see the entries, okay? So I don't expect you to enter in the 1 hour, 50 minutes, right? Unless you are kind of a bigger time frame trader. But I am guessing because of the majority of my students are intraday traders, they are using the 5 minutes all the way towards the 1 minute time frame. So pay attention to this consolidation model in that time frame. 5 minutes, 4 minutes, 3 minutes, 2 minutes, or 1 minute time frame. Mark it like this, take a screenshot, remember the economic calendar and the time that the trade took place, and post it in the homework channels. Right? This will be everything for today, fam. Now also will come to start yapping. God bless you. We'll be talking to each other pretty soon. Bye-bye.
No, YouTube is still fixing YouTube. So I'm gonna do the trade review real quick. So I'm gonna ask the questions about what do you see, because witness is recording the screen, okay? basically. The first step, what we have in 30 minutes time frame is we have this FG. This FG is going to be the important one. It's because this FG is before the break of a structure. And by the way, this is the only FG we have actually. That is the only FG that we have. First step is going to be completed. All of the analysis is going to be based on the FPG. So next step is going to be 1 minute time frame. In 1 minute time frame, we have right here. If you remember in the morning, I give you this level basically because we have the FG. And actually, I'd say this is going to be objective, and at the same time, this is going to be a high probability reversal. So what we have above the liquidity, because this is external liquidity. In lower time frame, this is external liquidity. In higher time frame, this is just internal. Or in lower time frame, this count as an external liquidity. So what we have above the equilibrium and at the same time in this count is we have an FPG. That FPG is the first PD array above the equilibrium of the 30 minutes FPG and at the same time is above the liquidity. So we already have completed the step 1, 2. Now we are just missing the step number 3. Right here is it. So first of all, remember I said mobile liquidity because witness teaches to use. So the market take external liquidity in this line. At the same time, the market take external and internal, you see? And when the market take the internal liquidity, at the same time, the market make a reaction in the second step, the 1 minute FVG. So first, this is going to be the first confirmation for look for shorts. The market respect this level and make a reaction in the internal liquidity. The second confirmation is going to be when the market make a reaction in this rejection block. If you see the market make 1, 2, and 3 reactions in that rejection block, but nothing close above. So this count as a confirmation. So now we're just gonna wait for the market close below the important low. Why this is going to be the important one? It's because this is a reaction in an FPG, and at the same time, this is in 5 seconds time frame. It's because this is a reaction in an FPG, and at the same time, this give you the internal liquidity. Comes from the external and give you the internal liquidity. This also is an important low, but the important one is going to be this one right here. This is an internal. This is going to be the external. So when the market closed below that low, from the swing to the swing, you're gonna look for this cone. So like the market take external and internal liquidity, I'm just gonna wait for the market make one retracement on this cone and then make the dump. Basically the entries on the retracement, stop loss above the FEG, 12 ticks in stop loss, and the rest is history. Like I said, after the market make a retracement, I just wait one retracement, not two. The market made two actually. I take an entry in the first one, and then volatility, retracement, volatility. You always aim for liquidity. This is actually like 2020 model, but yeah. You always aim for liquidity, one risk, 27 reward, 12 ticks in stop loss, and done basically. Pretty simple, pretty easy. Based on the analysis, interactions. That's why you in this example you have two confirmations. Most of the time I just have one confirmation. So that's basically why you wait for confirmation, because the confirmation give you the confidence to take the trade. Basically. Do you, ma? No, you have to identify important ones. I actually teach you how to identify important ones before and after a break of a structure, mm, reactions in another PD arrays, top and bottom. The narrative also depends the narrative of the die. So depends of many things to be honest to identify a PD array. You know. So yeah, do you have any questions so far about this trade or all good? Yeah, that's the problem. I think that is the problem. How to identify K levels, important PD arrays. What the fuck? And no worry, we're gonna teach you that. Actually, I teach you that in my way, but you have to take literally a class about that. And yes, Mr. Witness is gonna teach you that. Because I teach you in my way with examples, but it's better if you focus on that literally one class about that. So yes, Mr. Witness teach you that, so no worry about that. Yep. Literally, that is basically going to be about price action, my best favorite topic. My model? Yeah, because you don't have problem with the step 2 and step 3, right? You have problem with the step 1. That is the only thing I think you have problems. Yeah, so yeah, no worry, no worry. If you're doing good with the other steps, you just have to fix the first step and you are done, you know? So no worry about it. Oh, when it's all-time hacks, that is, yeah, that is something apart. Yeah, something apart. No worry, no worry about that. So yeah, all good for the, what the fuck? So all good with the trader review of today? Because we are, what time frame do you see right here? Well, maybe you don't see right here, but it's 9:38. So how to identify in which time frame you have to stay? It's based on the volatility. I talk based on experience, okay? So if you have volume, you're not gonna go. I mean, if you have a lot of volume, you're gonna go to seconds time frame. But if you don't have volume, you're not gonna go to seconds time frame. It's like high volume, less time frame. You know, less volume, high time frame. So you're not gonna go and trade seconds time frame in Asia, and you can trade 5 or 1 second in New York IM. You know, but sometimes, we have a lot of volatility in Asia, Trump speaking or something like that, and you can go to seconds time frame. But what I'm talking about is the volatility, the volume. So that is basically how you identify an entry too, you know? So yeah, if you don't have another question, that is basically going to be all for the class of today. We're gonna see you in the next live stream or in the next class. Bye bye.